Hi everybody, welcome to the Shock Factor series of video 16. And again, we shall be looking at the 16th hurdle in trying to apply technical analysis in the markets. Again, this is Shock Factor video number 16. So let's press on to the next slide. Again, in this video, I shall be focusing on timing and pricing discrepancies during technically based entries. So again, just to make the point very clear for the sake of ultimate and utter clarity, we are only going to be dealing with entry orders. That's all. With respect to the timing and pricing issues that we may face, and in fact, you will face, let me just rephrase that, whereby you will face while trying to enter the markets. Okay? All right. Okay, let's press on and see what this is all about. Again, it is a very enlightening video, to say the least. Okay, let's press on to the next slide. Again, the first thing I'm going to be elaborating on or trying to expand on, which is respect to pending orders for entry into the markets. Okay, so we shall be looking at the various timing discrepancies and how it affects the trader. The first thing we shall be looking at will be timing discrepancies. And this is basically with respect to pending orders, which we use to enter the market. Let me just repeat this again. In this entire video, I will only be focusing on entries, okay? Entry orders. So let's try to unveil the type of timing discrepancies or timing issues that a trader may face when using pending orders to enter the market. Let's press on to the next slide. Let's start with pending orders for entry and the type of issues that the trader may face in trying to implement entry into the market by using pending orders. Now, one important point before we carry on, charts are drawn based on bid prices. Well, 90% of retail trader charts that's available to the public for trading the markets, most of them basically are drawn using bid prices. What I mean by that is this. Here we are. Charts are drawn based on bid prices. Okay, for example, this is price action. This is a series of candlesticks, bullish and bearish candlesticks, as the market moves towards the downside. Okay, as it progresses, as it traverses the market towards the downside or going south slightly, you see two horizontal lines. The lower one basically represents the bid price. The one above it represents the ask price. And again, this is at 1.2833, as you can see, 1.2833, and the bid price is at 1.2823. Obviously, the bid price must always be lower than the ask price. Otherwise, you'll be a billionaire in no time at all. And the brokerage will close down almost instantaneously. Okay, right. So again, this is the bid and ask. This is how it is represented on a chart. A standard retail trader chart, okay? Standard chart. Now, more professional charts, they also allow you the option for charts to be drawn based on mid prices as well. I mean, you have those kind of charts, but I don't recommend using those kind of charts unless there is a specific purpose that you want to do something like that. Normally, we use what most people use. The reason for that is so that we can see what everyone else is seeing. We can see what the predatory manipulators and algorithms are sensing in the market. We can see what they see as well, what they sense in the market. That is very important, to see what other traders are seeing, to see what other market participants are seeing. That is critical. You need to have that insight into the markets. If you configure your charts or your indicators and oscillators in such a way that only you can see something that no one else can see, you are at a disadvantage, generally speaking, unless you're trading a very specific type of methodology. Okay, in that case, that would be the exception to the rule. So let's press on. So important point here, charts are drawn using bid prices. So as you see here, this last bearish candlestick, as you can see, the prices is here right now. The chart, all these candles were drawn using the bid price. Nothing to do with the ask price. The ask price is basically just floating above the bid price. That's all. It's doing nothing except giving you a chance to enter the market based on a buy order. That's all. It is not responsible for what you see on the charts. What you see on the charts, basically, it all comes down to the bid price. So again, let me just summarize quickly. The ask price has nothing to do with what you see on the charts. What you see on the charts has absolutely nothing to do with the ask price. It has everything, every single thing to do with the bid price. Okay, you got that clear? And the difference between the two between the ask and the bid is referred to as the spread. And in this case, 28.33, 28.23 is a 10 pip difference. Okay, here I'm using 4 decimal place. Let's press on to the next slide. Okay, let's carry on. Let's do a quick recap. We buy at the ask. We can only buy at the ask price. That means we can either buy to open a position, a new position in the market, or we can buy to close an old position in the market. So to buy to open a new position is called to go long. You are going long in the market. You're buying to open a new position. Buying to close an old position means that represents either a stop loss or take profit. Okay? And again, you can only sell at the bid. Okay, so if you sell to open a new position in the market, you are referred to as going short. You're shorting the market. If you sell to close an old position, basically that only means that you're exiting either via the stop loss or the take profit. Either you have a loss exit or profitable exit. That's all. Similar to this one over here. So whenever you buy to close or sell to close an old position, it is either exiting at the stop loss or the take profit. Stop loss or the take profit. Okay, whenever you buy to open or sell to open, you're entering a new position in the markets. Okay, let's press on to the next slide. Okay, let's observe scenario number 1, where we use pending orders to enter the market. Okay, let's look at this scenario here. Okay, assuming price went up, reversed at a certain level, creating a resistance level. So this represents a resistance level in the market. Price went down and eventually retraced and rebounded back to the upside. Now, what the trader wanted to do was to buy the breakout. So the trader wanted to buy a breakout of this price, anticipating or hoping that or believing that if price rises above the resistance level, which represents a breakout of the resistance, price may continue to move to the upside. So that was basically, let's assume that that was the basic understanding, the basic intention of the trader, okay, in trying to capture some profit in this market. He's trying to buy the breakout of a prior resistance level. That's all, simple as that, nothing complicated, no rocket science involved. So again, don't forget, so the market moves up, the market moves down, makes its way back up towards the resistance level, and again, what the trader did was he or she put a pending order to buy to open, to enter a buy stop order. That means if prices penetrates this resistance level, that trader will enter the market in anticipation of prices moving higher, giving a profit, a gain, okay, based on the long position that he has basically established in the market. So he put the buy stop order somewhere here. So again, unknowingly, the trader placed an order to buy above the resistance level, hoping for a breakout of the resistance. Unfortunately, that trader did not understand spread mechanics, the mechanics of the spread, okay, and how spread works in the market. Let's assume we have a bid-ask spread of 10 pips. Let's assume it's a Forex market. Since we're using pips, this particular Forex pair has a spread of 10 pips. So the trader wants to buy one lot here. It could be a mini lot, standard lot, micro lot, whatever it is. Okay, whatever it is. Again, if it's a futures contract, it could be one contract, two contracts, whatever. Okay, it doesn't really matter. This is just an analogy. That's all. Just an illustration. But I'm using Forex in this example just for the sake of identifying the market that we are trading. That's all. Okay, so we have a spread of 10 pips. So the trader puts a buy order above the resistance level at this level here, at this exchange rate level here, and he's now waiting for the market to trigger or to execute or to fill his buy stop order here. So as the market moves up, unfortunately, when the market reaches this level here, which is way below the resistance level, guess what? The trader's order will be filled. He will be in the position. It will be live. All right, so this is a live order. He's already in the market. But the problem is this: the market prices are drawn using the bid prices. So therefore, if that trader was observing the charts, he will see that the prices are here, but then he will be filled here already, as if there was already a confirmed breakout. But that is not the case. This is an unconfirmed breakout of resistance. The market is only here. Visually, optically speaking, the price is only here on the charts at the moment of entry. So once the market reaches this price, the bid prices are only here, but the ask price is already at the level where the trader entered his pending order to enter the market, obviously. So his buy sub order has already been filled. He's in the market. But if you refer to the charts, the prices are only here. There is no actual breakout on the charts. Visually speaking, optically speaking, you don't see a breakout. It has not reached or penetrated the resistance yet. So this is a big problem. The trader entered a long position in anticipation of the market moving to the upside too early, because on the charts, prices has not actually penetrated the resistance. It's only here. So therefore, buy sub orders tend to experience premature or unconfirmed technical base entries. This is an unconfirmed breakout based on what you see on the charts, because the charts are based on bid prices. What we can say is that the traders entered a breakout when there was no breakout whatsoever. It's premature. It's too early. It's an entry that's too early. The prices has not even reached the resistance level, let alone breaking above it. This is the problem with pending orders for entry into the market. Okay, again, the larger the spread, the more premature the entry. Okay, so now let's press on to the next slide to observe scenario number 2. Okay, scenario number 2, again, we're still using pending orders to enter, but again, now we're going to focus on the buy limit order. So the market is moving down, creates a support level, a very important, let's say this is significantly clear and obvious to everybody, okay, on this particular time frame. So this is a level that everyone is watching. All market participants are watching this level, okay? So it's an important, significant level. Let's assume that that's the case. So market moves up, it comes down again, and finally hits the support level. Now the market is at the support level. Don't forget, these are bid prices. Okay, these are all drawn using bid prices. So now the bid price is here. But guess what? The trader wanted to enter a buy limit order in anticipation that prices will rebound to the upside. It will come down in anticipation that it will rebound to the upside. So the trader entered an order here to enter a buy, hoping that the prices will rise. You buy low, you sell high. Okay? So when the market reached this level, don't forget these are bid prices. When the market reached this level here, will the buy limit order be filled at this level? No, because you can only buy at the ask. Okay, so the ask price has to reach this level in order for this limit order to be triggered or to be filled. But by then, optically speaking, if you look at the charts, prices had to come down to this level in order for the ask price to be at this level. Okay, here, 10 pips above. So optically, the price is already here on the charts at the moment of entry, because at this point, the ask price will be at the level that the trader wanted to enter the market with a buy limit order, and that will be filled. He will be in the market. He will have a live order. But the problem is this. The prices are actually here. If you visually look at the charts, the prices has already penetrated the support. So the whole world, all market participants all over the world can see that prices has already penetrated the support. The support has failed to hold this level. You see that? The sellers are in control, not the buyers. So again, summarizing, what is actually visually seen on the charts or observed on the charts is this: prices broke the support level and right now is here. What you see on the charts is here, but the ask price is here. And this is a price that the trader wanted to get in with the buy limit order. So yes, he or she will get in. But it doesn't make sense. It doesn't make any sense whatsoever. The market has already broken support. Why are you getting in when support has broken? Everybody else will be shorting based on what they see on the charts. Can you see that? The whole world will be shorting. You are the only one, or probably one of the few, that still very optimistic and going long here. But there is a confirmed breakout of support on the charts. And only somewhere around this level, the trader gets in with a buy order, a buy limit order. It doesn't make sense. You see that? This is the problem. So a buy limit order or buy limit orders tend to experience late, technically based entries. The larger the spread, the later the entry. So although the trader got in here, hoping for a rebound to the upside, in reality, visually and optically, look at the charts, the market has already broken support. Why are you getting into a position where it is obvious the market has already broken support? Why are you going long where everyone else is going short? This is a very dangerous position to be in. So this is the issue of what I refer to as late entries for buy limit orders. Specifically, if it's a pending order. A pending order. That means a buy limit order that you place below the market here. You will be entering late. You'll be entering in a nonsensical manner. Market has already obviously broken support and you're going long. This is the ultimate contrarian. But some people do that. They have a lot of faith and optimism. They believe that market always rebounds, but you need to have deep pockets just in case it continues to the downside. And this breakout is assuming this breakout is very decisive. It's a decisive breakdown below support. Then you're in trouble. Okay, not in every case, but generally it is not good to be in that position. It's not a good thing. So this is the problem. The larger the spread, the later you'll get into the market where the market has already broken the support level. So why are you getting in when the market has already penetrated the support? You see, where everyone else is shorting. This is the problem. Let's press on to the next slide. Let's ask the question. If we revert to market orders for entry, to enter market using market orders, will there be a timing discrepancy? Well, when using market orders, where entries are made at the market, that means you enter a live order. As you're watching the market, you're watching the charts, you see prices moving. Of course, there are bid prices that are being drawn on the chart. Bid prices are being displayed on the chart as the candles, the bars, and all the other types of representations, whichever that you're using is as you see on the charts, you're trading at the market. Whatever you see on the charts is what you're trading. That's what I mean. Whatever you're seeing on the charts, whatever price action that is unfolding in the charts, and you're trading that particular price action, you want to enter the market live using a live order is always a market order, by the way. So this is what I mean by a market order. It's a live order. You're sitting there, finger on the button, ready to pull the trigger. Once you see prices hit the price level that you want, that's what I mean, at the market. So if you use a live entry, a live manual entry or whatever it is, you're entering using a market order for entry into the market, you will not have a timing discrepancy. No. This will not exist. You know why? Similar to these two scenarios, scenario 1 and scenario 2. You'll be watching the markets as it comes down. In this case, as the bid prices hit this level, you will enter a buy. To enter a buy limit, or you enter a buy at this level. Okay? But the problem is that the actual ask price will be up here somewhere. Although you're entering using the bid price at this level, the exact level that you want, using the bid price, because these represent bid prices, the ask price will be somewhere up here. So you're actually entering above the market. Although, according to the charts, according to what you see on the charts, it comes down, it hits this level. This is the point where you enter the market, but you're entering at a higher price. I'll come to that in a short while. You see that? So therefore, for market orders, you do not have a timing problem. We have a different problem. You will have a pricing problem. That's right. Let me explain. So now let's switch over to pricing discrepancies for market orders to enter the market. Okay. So let's go scenario number 3. Now we are focusing on market orders in order to get into the market. We're not talking about exits in this video. So let's assume that the market goes up, creates a resistance level here, very important, very significantly clear and obvious and blatantly obvious resistance level where everyone on this planet can see, they can recognize this. Market comes down, very important. Everybody's waiting for this level to be penetrated. If you are a breakout trader, assuming. I'm not talking about support and resistance trading. I'm talking about breakout trading. So it goes up, on the way up again. And finally, you want to get into a long position. Once you see prices on the chart penetrate the resistance. So this is a confirmed breakout. On the charts, you can see it optically, visually. So this is the bid here. This is the bid price. The current bid price is here. On the charts, you can see it has broken above the resistance. So now you want to enter in anticipation, in the belief, in the hope that the market will move to the upside and give you a gain, okay? And give you some returns, in the process. So when the market reaches here, a clear, obvious penetration of the resistance, you enter a buy at this level. Optically, the price is here on the charts at the moment of entry. So when the market is here, you enter a buy, clearly as a broken resistance. This is a clear indication of a confirmed breakout. But what actually is happening, because you only can buy at the ask. You can't buy at the bid. So you're actually buying here, although the market's here, but you're buying 10 pips above. Can you see the problem here? So you're buying much higher than where you intended to get in. You have no choice about this. Unless your spread is zero, then everything is hunky-dory, the skies are blue, and the birds are singing. Beautiful. But there are brokers that can offer you zero spread. Yeah, they exist. But to be able to qualify for zero spread, we should solve all these problems. Yes, they do exist. Zero spread is the ultimate facility that a broker can offer you. In order for you to qualify for zero spread account, there are very strict conditions, very demanding conditions. For example, you must trade a certain volume. Normally that volume is pretty high. So the broker can forego the spread, but they charge you a higher commission and imposing a minimum quota of volume that you have to fulfill in order to be able to continue to qualify for zero spread account. And you need tremendous capital for that to occur. Tremendous. I'm not going to go down that road again. That's a different topic altogether. But it does exist. Just to give you a little bit of hope there. Okay, so we all don't get too depressed as we go forward. So again, you're buying at a higher price. The moment this was where you entered, the timing, this was where you entered the market because it has a clear breakout of resistance, but this was the price that you bought at. So again, live buy orders or market orders tend to experience more expensive entries. You're buying at a much higher price. So normally if you want to enter a buy order above the market in anticipation of a continuation to the upside, you will normally get in at a more expensive or more pricey level by virtue of the spread. So now let's move on to the next scenario where the market is now moving to the downside. It creates a very strong support level. Everyone can see this. It's significantly clear and obvious. It comes down, goes up, back up. It comes down. It goes back up and then finally comes back to retest this level. So again, in this scenario, the trader, his intention or her intention is that they believe that the market will come down, hit the support level and rebound to the upside. Just like in scenario number 2. But in this case, it's slightly different because the trader is sitting there in front of his trading platform, watching it live as the market comes down. These are our bid prices. The market are drawn based on bid prices. And once the bid price reaches this level, which is what the trader is seeing right now, optically, the price is already here on the charts at the moment of entry. So it comes down to this level, which is a level that trader wanted to enter a buy position. So he or she pulls the trigger, hits that button, got into the market. Now that trader is live in the market because prices has come down to the level that he or she wanted to get in with a buy order in anticipation that the market will move to the upside. Little did that trader know that when he or she entered at this position, this was a moment of entry when prices were at this level, that trader actually bought at the ask price, which is 10 pips above, because he can only buy at the ask, you can't buy at the bid. So the trade is buying much higher than what is shown on the charts. But unfortunately, because it's a buy, you have to buy at the ask. You have to go long at the ask. So you buy much higher. And again, the same thing happens. For live buy orders, regardless of whether it's buying above the market or below the market, it doesn't matter. It is always going to be a little bit more expensive. You'll be buying at the less advantageous price. You'll be buying at the higher price. Similarly here, you enter the breakout, but you're buying at a much higher price. You're not actually buying at this level. When the chart is at this level, but actually you're buying higher. Similarly here, you enter the chart at this level. Visually, this is the level you want to enter. This is a support level, but you're buying 10 pips higher. You're buying at a relatively more expensive price. You're buying higher it is less advantageous. You see that? It's more expensive. So the larger the spread, the more expensive the entry. The larger the spread, let's assume it's 20 pips. So although you enter market at this level, visually speaking, this is what you see on the charts, you could be going long much higher. Higher. So the higher you buy, the less advantageous it is to you. You earn less. Okay. The lower you buy, the higher the probability you make more money. You have more gains. Okay. The higher you buy, the less you make as the market moves to the upside. Okay. So again, going back to the earlier slide, the larger the spread, the more expensive the entry. So therefore, you have seen in all four scenarios, either you're going to be entering too early, prematurely. You're entering too early when things are not confirmed, when your entries that you anticipate has actually not been confirmed yet. Technically speaking, on the charts, it has not been confirmed. Here, you think you're entering the breakout, but actually prices are still below the resistance. There is no actual breakout. So you're entering too early. The breakout has not been confirmed. So you're entering too early. The other thing you can face is that you enter too late. So pending orders, you're either entering too early or too late. The larger the spread, the later you are. The larger the spread, the earlier you are. The more unconfirmed your entry is, especially in this case here. The more premature and unconfirmed. For pending orders. For entry pending orders into the market. And for market orders, it's a bit different. You face a slightly different issue. You're normally entering the market in a relatively more expensive level or exchange rate or price level. You see that for scenario 3 as well as for scenario number 4. It is normally more. So for market orders, if you're entering using market orders to enter the market, normally you will experience a pricing issue. You're entering at prices that are very disadvantageous to the trader. But if you're using pending orders, it's different. You won't get that issue. You won't have a pricing issue. You will have a timing issue. Either late or too early. But there's no pricing issue. You only have a timing issue. You see that? So regardless of whatever all this means, at the end of the day, we can always summarize. Let me summarize everything. In summary, all entries, again, we're not talking about exits in this video, all entries, be it pending or market orders, will suffer from these issues. Either you're going to face a timing issue, entries are too early, or entries are too late. And this specifically relate to pending orders. Pending orders, you either enter too early or too late, but there are no pricing issues. But for market orders, you will face a pricing issue, but no timing issue. You won't have a timing issue, but you will normally enter at a less advantageous price, relatively more pricey, more expensive. Okay, for entry. You see that? So either you're going to have a timing issue or a pricing issue. You won't have both. It's either this or that. Regardless of say, at the end of the day, the trader will always be disadvantaged, regardless whatever you do. Whenever you execute, whenever you orchestrate an entry into the market. Either way, whatever you do, either you're going to have a timing issue or a pricing issue. And again, there's no way to avoid this. It's not possible, except for one way. You find a broker and you fulfill the conditions to open a zero spread account. That's the only answer. One of the only answers that can solve all this once and for all. Very few can do that. You need tremendous capital, tremendous trading volume. And therefore, again, most traders will always be disadvantaged when entering the market. But exits also has its own issues. Yeah. But again, in this video, I'm only focusing on entries, and you can see the problems already. So, okay, that brings us to the end of this video. Again, I shall see you very shortly in the next video. But until then, as usual, take care, be safe, and bye-bye.